Understanding the relationship between rates and yields on one hand and bond prices on the other is going to be central to the Series 7 and probably important on the Series 65 and the Series 66. So I thought I would upload a 5-minute or so lesson. You may have seen some of our other videos, but we are past the 7, past the 65, and past the 66.com. Try to talk to you in plain English while we still provide you with very challenging questions as well. But let's focus on bond yields, because understanding that could lead to getting 5 or 10 more questions right on the Series 7 and several questions on the other two as well. It's important to remember what the language means on the exam and in the industry. Fixed income. If you buy shares of common stock, you're often just buying hope that the value will go up over time, even though it's going to fluctuate. If you're buying a bond, you're buying a fixed income investment. The bond is going to tell you what your nominal rate of interest will be every year, and it's not going to change. So if you're looking at a bond with a 6% nominal yield, you have to know that means 6% of the par value will be paid to the current holder of the bond, no matter who he or she is. So no matter what happens in the future, the bond will pay $60 per year. Obviously, you're not going to buy one bond, but if you had $1 million in these bonds, you'd be getting $60,000 a year in income. Period. End of story. At the end, no matter who currently holds the bond, whoever's holding it at maturity, this bond will pay out $1,000, period. So if somebody's holding a 6% nominal yield bond, which could be called the 6% coupon or a 6% bond, it is going to pay $60 a year. But if interest rates start climbing, the market value of the bond is going to have to go down. Because if interest rates are going up, like you notice on mortgages or home, whether it's home or auto loans or maybe student loans, those rates are up. Well, yields on bonds will also be up with these rates. The only way for that to happen on your bond, if you're the holder, is for its market price to go down. Now, you could tell yourself it doesn't matter, I'm not going to sell, but when you open up your 401k or IRA statement, or maybe you hold it in a taxable account, your statement shows you that the bonds you own outright or in a bond mutual fund, their value is down. And then if you get in a pinch and you have to sell, you can end up taking a loss. So rates up, price down. That is interest rate risk. So what happened? Did your yield rise or did your price fall? It's the same thing. So if you need to sell, you're going to maybe take a loss, and even if you don't need to sell, you're down. It's a paper loss. So if you did have to sell, you'd have to offer your bond at a higher yield to another investor. And if we factor in the price that somebody pays, we're talking about current yield. This bond will always pay 6%, which is $60 a year. But if you sell it for only $800, somebody else's current yield is going to be 60 divided by 800, which is 7.5%. Get my little pen here. So whenever you see that there's a nominal yield of 6, for example, but some other yield is higher, current, maturity, or call, you know the bond's trading at a lower price. This is called trading at a discount. The yield to maturity on your bond, unfortunately, is even higher than that. Why unfortunately? Well, if you did have to sell, or even if you're just looking at your statement, if the market price is 800, that's another way of saying the current yield on the bond with a 6% nominal is 7.5. 60 out of 800 is 7.5, which is higher than the stated yield. But yield to maturity means, well, if somebody bought the bond and held it to maturity, they'd get all those interest payments, plus they'd make the par value at the end, they'd make an extra $200. We're not going to do the math, but we'd be factoring in that extra $200 over whatever the time frame is. If it's 10 years to maturity, they're making an extra $20 a year. If it's 20 years to maturity, they're making $200 over 20 years, an extra $10. So yield to maturity is higher than current yield because in this case it factors in the fact that they're going to make a $200 gain. We'll annualize it because that's how we like to do things. So whenever you see 6% nominal and the current or the yield to maturity is higher than that, the bond is trading at a lower price, a higher yield, same thing. So the test may go in this kind of direction. Which of the following bonds trades at a discount? And maybe they make this a Roman numeral question. Well, at a discount, remember, means the price is down. And another way of identifying the price being down is that the yield it's trading at, or would, is up. I'm sure some bondholders don't even know that their bond has a market price. They just thought you bought them and you held them till maturity. Nothing wrong with being a pure fixed income investor, but you may have to sell your bond, and these people should know that their bonds are all trading at a lower price. If they have a 6% stated yield, but they're actually trading at a price that makes the yield higher on the secondary market, all of these bonds would be trading at a discount. Kind of counterintuitive, you know. People see this yield higher, they want to call that a premium. No, the yield went up because the price went down. So whether it's current or maturity or even yield to call, if it's higher than the stated nominal yield, that's only because the bond price dropped. Again, bonds are fixed income. As I make this recording, interest rates are extremely low. If you had bought the bond 10 years ago, maybe it was paying 6%, and it always will. But if interest rates in general are down, mortgage rates, auto loans, everything else, that means that bond yields are down, and so your bond's market value is up. If you want to sell it, you can sell it at a lower yield in line with low interest rates. So when the Fed starts easing, they're lowering interest rates by increasing the money supply, they're going to make your bond values go up. But if they keep them down too long, your yields going forward are going to be really low as well. But one thing at a time. Actually, you can't do it just one thing at a time, but yields are down. But if you needed to sell, you could actually make a capital gain, or you could just smile as your account statements come in and your bond fund, the net asset value, is temporarily up because the market values are up. If you go to sell your bond, you're going to sell it for a higher price, or is it a lower yield? Same thing. So somebody buying your bond for $1,100 would be getting 60 out of $1,100 for their current yield. You may have to calculate that, whether it's a stock or a bond. Current yield just means what's my income divided by the market price. Well, we know it's lower than 6%. It's 5 something. And if we factor in the yield to maturity for somebody buying the bond at a premium, that's going to be even lower. Why? Because no matter what you pay for the bond, at maturity, it pays out the par value. So now this investor is going to lose $100 over the maturity. If that's 20 years away, it's probably not a big deal, right? That would be $5 a year. But if it's only 5 years away, then they're losing $20 a year, and it's going to be a low yield to maturity. So right now, with the Fed pushing down interest rates and the economy not really humming along, rates are low. That means that yields are low as well. And bond prices are probably trading, a lot of them, above the par value. So which of the following bonds trades at a premium? A premium. Well, here the yield is up above the stated rate. So that's actually a discount. Here the yield is up above the stated rate, so that's trading at a discount. Here, this looks pretty good. The yield is down. And if it's still has a yield to maturity the same as the nominal, it's trading at the par value. So the only one where the price is up is this one, where the yield is down. So as interest rates drop, your bond market value may rise. If you go to sell, you may have a capital gain. So again, when rates go up, bond prices drop in order to push the yields up. Interest rates and bond yields are intrinsically related. Your mortgage rate could be tied to some yield on the 10-year Treasury, for example. So they feed off each other. So rates and yields are the same thing. Bond prices are down if rates are up. On the other hand, if rates start going down, bond prices rise, and then if you sell your bond, the guy buying it will get a lower yield because that's the new interest rate environment. Exciting stuff. Well, I hope that clarified it a little bit. If you have questions, visit our website, Past the 7 or PastThe65.com. Notice that we have full packages, which are the textbook, the online exam questions, and the DVD set. Make it a lot more fun and speed up the learning process. But we also offer tutoring as well. And when I made this recording, this was the rate. Most people do a 2-hour session. But you schedule 2 or 3 2-hour sessions, we can usually take your test score up 5 or 10 points, which is probably about all you need. But we better keep this as short as we possibly can. So thanks for attending our mini class on bond yields.